Imagine spending an hour with the world's greatest traders. Imagine learning from their experiences, their successes, and their failures. Imagine no more. Welcome to Top Traders Unplugged, the place where you can learn from the best hedge fund managers in the world so you can take your manager, due diligence, or investment career to the next level. Before we begin today's conversation, remember to keep two things in mind. All the discussion we'll have about investment performance is about the past, and past performance does not guarantee or even infer anything about future performance. Also understand that there's a significant risk of financial loss with all investment strategies, and you need to request and understand the specific risks from the investment manager about their product before you make investment decisions. Here's your host, veteran hedge fund manager Niels Kostrup Larsen.
You're listening to Top Traders Unplugged. Thanks so much for tuning in today. I know how valuable your time is, so I do appreciate you spending some of it here with me. And also thank you so much for sharing the podcast with your friends and colleagues. It really does help me expand the reach of the podcast so that more people can learn from my amazing guests. On today's show, I'm talking to Anders Lindell, co-founder and chairman of IPM. Anders was influenced early on in his career by some extreme market events such as the equity crash of 1987 and the attack on the Swedish central bank in 1992, where overnight rates reached 500%. To essentially go down the path of finding value in going against price drift and dislocation away from the fair value or intrinsic value of markets. This path has taken him to the top of the hedge fund universe with more than $7 billion under management in a relatively short period of time. IPM's global macro strategy is fascinating in its structure, and so is the story of how Anders realized his success. For those of you who are new to the show, I just want to let you know that you can find all of the show notes, including a full transcript of today's episode, on the toptradersunplugged.com website. Now let's get started with part one of my conversation. I hope you will really enjoy this. Anders, thank you so much for being with us today. I really appreciate your time.
Thank you, Niels. It's a privilege to be here.
Fantastic. Now, as I was preparing for our conversation today, I couldn't help think about the many times you hear on the financial media how a particular analyst or economist suddenly revise the estimates that they have or the forecast that they have for a particular market. And very rarely are these analysts held to their initial forecast. And I also seem to remember an old saying that if you give 10 economists the same set of data, they'll come up with 10 different opinions of what it means and what's going to happen. And I think most people would agree that this is not a good foundation of managing money. You shouldn't be swayed in your opinion every time there's a new set of economic data being released, as this happens nearly every day. So I'm interested in finding out through our conversation if you at any point in your beginning belong to this type of analyst or economist that would revise forecasts and opinions based on new data, or whether you've always had this, can I say, rule-based or mechanical approach where you organize fundamental data so that it can be implemented in a non-emotional and disciplined way. So, and with your investment universe truly being global, I'm really excited about all the possible topics that we can talk about today. But before we go into all of these details about your company, where it is today, I'd really like if you could take us back to the beginning and telling us your story and what led you to take this path, and feel free to go back as far as you want. What would you like as a teenager or whatever you feel like sharing with us today?
Fantastic, Niels. Well, we shouldn't go so far back as my teens. That would be far too much detail for this particular conversation. But anyhow, I think it's material for my future development and also the origins of this firm. That I actually started out as an engineer. So I went to technical university in Sweden, focused on control theory and mathematics. Okay. And indeed, my first work or job immediately after university was actually selling and designing, building, implementing control systems for paper and pulp mills.
Okay.
And obviously, this is a very structured process. One has to, account for, various inputs and data given by, a large number of various sensors, and one has to respond or program the system to respond, in a repeatable and controllable fashion.
Sure.
So I think this is actually quite relevant. Following that, I spent a couple of years doing that. I further educated myself in the field of finance, and then started up a career at a fixed income trading house called JP Bank, a domestic Swedish bank at the time, and now we're in 1993.
Okay.
Here I started out as an analyst and basically spent my first year there analyzing commercial paper programs for various corporates that the bank represented on the market.
Okay.
Moving on, I moved to the position as economist, and this is basically very much focused on macroeconomy. Mm-hmm. And indeed, as this was a domestic house, 99%, I dare say, of the focus was actually Swedish government finances and political development.
Okay.
And as I'm sure you recall, those were quite interesting days following first, in the early 90s, the sort of famous attack by a certain George Soros on Bank of England, and then probably a globally half-coordinated attack on Swedish currency, interbank rates moving as high as 500%, late fall 1982.
Yeah.
Then we had our own crisis. So basically what we did then was, to inform our clients to the best of our abilities of any underlying macroeconomic and political trends that would lead to a significant improvement in government financing and the debt situation. And this is indeed something that a large number of global macro funds focused a lot on as they took significant positions in Swedish government debt.
Okay.
So in touching on your initial question there, have I been an analyst that sort of revises and changes? Well, to some extent, obviously one has to account for new information as and when it gets released. On the other hand, I think it's always important to note that individual data points may actually lead you astray, and quite significantly so, as an economy actually does move in and change in a relatively slow and moderate fashion. It would be rare unless we're talking about potentially countries like Argentina or whatever, sure, to see developed economies turn 180 degrees overnight.
Right.
So this has always been, in my mind, a slow-moving process. One has to account for obviously new data, but only as an average and trying to see the longer-term development rather than focusing too much on individual data numbers.
Sure.
So these were very interesting times, obviously trading fixed income and Swedish government debt in the early 90s.
Yeah.
As the Swedish economy started improving, mid 90s, And basically throughout the 90s, spreads to international markets, most notably the German market, started compressing quite a bit, which is obviously what our clientele had focused on and hoped for. Yeah. But at the same time, as things started stabilizing, actually the fixed income market domestically in Sweden got a lot less interesting than it had been. So by 97 or so, I actually started thinking together with my co-founding partner, who also worked at JP Bank at the time. We actually started thinking about, a next move. What could we do together that would make sense going forward? Because neither of us felt that this particular market was the place to stay around for another few years.
Sure.
So actually in early 1998, and with the background of many of our clients being not only international hedge funds, but also a large number of more traditional asset managers, pension funds, life insurance companies, etc., most of them in Europe, we started thinking a little bit about our experiences in dealing with them. And one topic, came back over and over again, and that was, from a pension fund perspective and a life insurance company perspective, how do you, what's the most important decision that you have to make as a long-term investor to gain, relevant returns on your funds?
Sure.
And the asset allocation decision, seemed to us to be central. And obviously there are two parts to this. Most of these funds then and now have a strategic long-term asset allocation where they set targets for any number of years, 3 to 5 years typically. How are we going to be invested in? What asset classes are we going to be invested? But there's also a shorter-term, quite interesting decision that is being made frequently by these funds. And that is, how do we deal with tactical deviations from these long-term strategic targets?
Okay.
And you can end up in sort of a situation where you deviate intentionally, or you can end up there because you've taken you've let markets basically push you in that direction.
Sure.
So irrespective of what has actually taken you to that point, how do you deal with the situation? Do you want to continue deviate from your benchmark? Allow that tactical bet, whether intentional or unintentional, to continue to play out, or do you want to reduce or indeed even increase that positioning relative to benchmark? So this tactical asset allocation decision is immensely important. Now, at the time, most pensions and lifers, I dare say, at least in Europe, made these decisions, in a very sort of traditional way that obviously had made a lot of sense up until then.
Sure.
Basically by, they had their in-house economist, and they invited the investment bank and other, more independent economists, and they read a lot of research, and then they had an investment committee that sat down on monthly or quarterly frequency, compiling and analyzing all of this data from various sources, and then making a decision to the best of their ability.
Sure.
And obviously, they were also exposed to, the analytical community and economist community changing their views and revising based on data points. So there's a lot of noise going into this process.
Right.
Another thing one has to bear in mind is that most of the decisions made by these committees or other sort of organs making those decisions were typically relatively modest in size. People, based on this information, knowing full well that it's a noisy and it's hard to analyze, rarely dared to make the bigger, bolder bets that would actually make make the needle turn at the bottom line.
Right.
So perhaps I'm exaggerating a bit, but the typical outcome of this would be to change your 60-40 stock bond exposure to 58-42.
Yeah.
This may or may not have been right. You may or may not have had the solid background to do it.
Sure.
But irrespective of which, it's a long and cumbersome exercise that really contributed a whole lot to the bottom line. What we had observed also, though, was that over in the US, a few firms had already started helping pension fund and long-term institutional investors with these decisions by way of providing basically an investment service to help them take more informed decisions based on a solid set of information, solid methods, and really do this in a repeatable fashion. So this is really what triggered us to start up this firm. Early '98, we sat down and said, let's try and do this to help mostly European pensions and lifers with their tactical asset allocation decisions. Mm-hmm. So this is really the starting point of the firm.
Sure. Before you maybe bring us sort of up to speed on then what happened from 98 and to where you are now, I just want to go back a little bit to the early 90s, because you mentioned, of course, in 1992, the Swedish Central Bank was offering 500% overnight rates. And I also seem to remember that in 94, I think it was, we had a bit of a surprise from the Fed that caught some people off guard in terms of the rate environment. Mm-hmm. And I just wonder, these extremes happening so early on, and I say early on in your career, but I don't mean it like that because I'm not entirely sure exactly when you would say your career started, but these extremes, do you think that they really were the ones that impacted you in focusing on relative value, saying, I want to be a little bit of a contrarian when these things happen because it doesn't make sense. We're not going to have 500% overnight rates forever. We need to do something going against that, or
yeah, it's a good observation, and you can actually throw in another sort of big event in 1987 when I had actually on my personal account, still in school, started trading a bit.
Okay.
I actually had rather big positions in the options market. Mm-hmm. Without really knowing too much of what I was doing. Obviously I'd noted that, trading options for the better part of 86 and early 87, I'd made, decent profits for a student. And then I pretty much lost it all in the ensuing equity market crash.
Yeah.
That was sort of formative. It's a brutal way of learning that before you start doing stuff and trading stuff, you should really know all of the ins and outs rather than just going with the flow. I think both of the events that you mentioned, the 92 500% rates here in Sweden, the 94 Fed hike, but I think perhaps even more, I learned this sort of longer-term outlook and the value of patience and solid analysis from many of the counterparts that we traded with, and basically the global macro hedge funds.
Right.
That started coming into the market with a view clearly stating that, hey, currency at 523, 24, 25 to the Deutsche Mark and spreads of several hundred basis points. This is going to play out in our direction over time, but you got to be patient. These are positions that you build to take a longer term view and really profit over the course of a couple of years, rather than trading in and out on individual months or trading too much based on sort of market volatility following the Fed hike, etc. So I think this way of analyzing markets with a longer term view, trying to get rid of the noise and really performing the analysis based on sound theory probably came from there.
Okay. Did you have any mentors when you first started out that you kind of looked up to, or someone who looked after you in a sense?
Not really mentors, obviously. Some of the folks and analysts at these global macro hedge funds were quite interesting people, and try to learn from them. We also had management at JP Bank, and head of the fixed income department at the time was a certain Ken Dianer, who subsequently started up the hedge fund Nectar.
Yeah.
And he was a demanding boss. He required nothing less than perfectionism, really, in our analysis, even down to the way we produced reports and how we phrased ourselves and what conclusions that could be drawn and not be drawn, etc., etc. And he was also a person that I think was among the first to bring in to Sweden a more quantitative approach to trading fixed income, based on his experiences from working in London a couple of years earlier. So perhaps he wasn't necessarily a mentor, but he was certainly a person that sort of set the bar and the standards.
Sure. Before we leave your story completely, today, of course, I know you have stepped down as the CEO, but being part of IPM and being chairman of that today is obviously a big part of your life. But what do you spend your time doing when you're not focusing on the business?
Oh, there's a lot of things that can be done. I've got 3 kids. That's a time-consuming business. Sure. And obviously approaching 50 years of age, one enters into a period when one has to start looking after health a lot more. So taken to, mountain biking, long distance running. Okay. But this is more to, sort of a housekeeping thingy, but it's also fun. Yeah. The greatest fun, off work would probably be, downhill skiing. Okay. Spend a lot of time doing that.
Fantastic. Great stuff. Now, I think for today's talk, we're going to be focusing on the systematic macro program, but perhaps you could just mention the programs you run today and when they started and what kind of assets you run in each of them.
Sure. Basically, what we say that we only have 2 programs here at IPM. One is the systematic macro program, which is a systematic global macro hedge fund. Yeah. And the other one is an equally systematic but long-only equity program. In the macro box, we're currently managing about $3 billion US, and the equities about 4. Okay. However, the macro program can also be run in slightly different forms. You can carve out, for example, the currency program and trade that alone. You can carve out, and people do carve out currencies and fixed income and trade that as a separate strategy. But they're all part of the broader program. All we do when we carve something out is we simply turn off the other processes. Sure. The macro program has been trading in account format basically since 2002. Okay. Our pooled vehicle started in 2005. That was a currency vehicle, and in 2006 the full macro program, both domiciled on the Caymans. The equity program has been running since early 2006.
Fantastic, great stuff. Now, before we jump into the first sort of topic, more specifically to IPM, I want to ask you, you mentioned the traditional 60-40 bond stock or stock bond, depending on whether you were European or US institution. They seem to have a little bit of a different asset allocation as far as I remember. But the world has changed in the last 10, 20, 30 years, of course. And I just wonder, from a really big picture point of view, how do you see them dealing with this asset allocation, not from what you do, but from what they do and how they may interact with firms like you? I mean, are they becoming more open, so it's not just 48, 52 that they change to, or whatever it might be? I mean, are they starting to take bolder decisions in their own asset allocation?
There's a whole range of answers to that. I think generally the answer would be yes, on sort of a global basis. I think if you look at US institutional investors, they probably come further than their European counterparts in allocating very significant parts of the risk budget to, folks like ourselves and generally hedge funds. Whereas, in Europe, finding a long-term institution having a hedge fund allocation exceeding 3, 4, 5% would be unusual. Finding the same in the US would be the norm, being north of that, even up to 10, 15%. Okay. That would be the norm. But then, you have obviously various examples. I mean, if you look at your own native country and the big pension fund there, ATP, they instituted, I believe, about 10 years ago, a radically different asset allocation structure from the traditional, where they basically, and you can correct me if I'm wrong here, but basically what they do is they sort of equal weight their risk budget across, 10, 15 different asset classes, ranging from infrastructure to, traditional markets.
Sure.
So people are doing a large number of different things, but I think the general observation holds true that North Americans, generally speaking, are much more into seeking alternative sources and allocating significant parts of the risk budget to those alternative sources of returns than Europeans are.
Sure.
Obviously, this also has something to do with, the state generally of the pension systems. If you look at U.S. pensions, corporate and state, they are generally underfunded to a very large degree, 60-70% funding ratio, whereas most European countries that has funded pension systems would have significantly higher funding ratios. Many of them actually 100% or better.
Okay.
So this obviously changes your long-term strategic allocation. Yes, you got to match liabilities, but if you're underfunded, and if you're running something at 70% funding ratio, then you better seek methods to make up for the shortfall pretty quickly.
Sure. Now, it's interesting you mentioned ATP. Clearly, that's a big pension fund in Denmark, and they have been, as you say, doing things a little bit different in the last few years. But what I seem to remember also from the press, because they did set up an alpha team and so on and so forth to actually take some of these strategy in-house, which I think from what I know, you actually are not completely unfamiliar with, that some of your clients might be wanting to learn from you, but we can talk about that. But what I also seem to remember about them is actually they ran into a little bit of problems from, I think, whether they were internal or more sort of image point of view about, having people sitting inside a pension fund who could in theory earn a lot more than an average salaried person because they were doing strategies and maybe returning some kind of or earning some kind of performance fee. So I think actually part of that unfortunately has been shut down, but that might be isolated to them specifically.
I mean, it's a general problem. Yeah. Obviously, if you're going to bring in people that can actually do this, you got to pay them market average. Yeah. Otherwise you're not going to be able to. Yeah. And additionally, I think most of the people that have tried insourcing have actually reversed and stopped doing that. Right. And I think one of the reasons is political. Yeah. And recently regulatory. But it's also the fact that inside an organization like that, you're not really going to have the entrepreneurial spirit that sort of constantly improves on this process. Whereas if you outsource to third parties that live each day by what they make, that's going to be a different story. So inherently, I think insourcing these rather specialized forms of management is very difficult.
Yeah. Interesting. Now, you mentioned sort of roughly $7 billion under management today. I want to talk just a little bit about the organizational structure. Running a big company like that, how have you decided to organize it, and what things, if anything, are you able to outsource today in terms of taking advantage of technology or specialized firms helping out, and just tell me a little bit about sort of your organization as it stands today.
I think the first point to note here, by way of background, is to know that we are 100% systematic. And by that we mean that everything that we do inside these two programs is actually coded into software code.
Okay.
And that's sort of a starting point. But it's also very important because with that structure, we can do things and we can scale the organization or the output from the organization completely differently from people that act more or less exclusively discretionarily.
Yeah.
So what we have at IPM, at the heart of IPM, is a research team comprising about 10 people.
Okay.
Supported by another 4 systems developers. And then, next to them out here on the trading floor, we have 3 traders and a couple of guys on risk, and this is at the heart.
Okay.
So their daily task is really running and maintaining the research team I'm talking about. They're really maintaining and further developing and researching the models that we employ. Obviously, they are also the persons, hitting the button on a daily basis to generate the trades and generally supervising that. But that's, in relative terms, a small part of the daily work, typically.
Sure.
So that's the main part of the machine. Supporting them, we have our own back, or rather more middle office.
Sure.
That does the traditional things. They check for risk and they check positions and they reconciliate with counterparties and clients.
Sure.
But that's actually only four persons. The remainder of the firm then is traditional functions, legal compliance, IT, as opposed to systems development. IT would be infrastructure, business development, key account management, or as we refer to them as investment strategists.
Yeah.
But it's really, the organization is really designed with us being 100% systematic in mind. So, and really to compare with someone, we're probably organized pretty much like your average CTA.
Yeah, sounds like it.
Yes. I mean, you wouldn't. There wouldn't be a big difference there. Although the inputs that we use and the models that we use are completely different, but operationally we function pretty much the same.
Okay. And in terms of growth of the business, I mean, I can imagine maybe legal and compliance is an area that's always going to grow with the way the world goes. But other than that, where do you see sort of, where would you like to see the AUM go to, sort of based on what you have now? And it sounds like you don't really need a lot of changes, even if you had significant increase in AUM.
It's a question we always get, and the typical answer would probably be that, I'd like to see our potential realized, and by that I mean that we'd like to get our AUM proportional to, the size of the asset pools in various markets globally, and that's a cryptic way of saying that we could see a lot more coming in from the US. We just started marketing over in the US a few years ago, got registered as SEC, CFTC, all of those things. Okay. But it's obviously a hard market to break into. Sure. And today we have a very, very small amount coming from there. But if we're going to move to a position over the coming 3 years where our AUM split reflects, the global asset split, right, then we would probably double to even triple our AUM,
Sure.
which is of course a very ambitious goal over something like 3 years. But longer term, we like to get to that point. And yes, as you observed, that does not mean that we're going to have to employ a large number of people. Obviously, some business developers and a few account managers. But in terms of research and other operations, not a whole lot.
No. Just one sort of final area before we jump on to sort of more the program specific issue. How do you spot talent that you want to hire for your business? What are the skills that you're looking for today? And are these skills different than maybe 5 years or 10 years ago?
It's an interesting question that we can spin different ways, because it actually applies to many of the things that we do also on research. We're not out there just looking for general talent. And we get a few applications per week from very talented people, sure, globally and domestically. But we're not too interested in that. Rather, we're taking the opposite approach. We're saying, here's our team, here's what we want to do. What do we need to get there?
Right.
Do we have the talent we need, or is there a specific area that is not, completely covered? If we find such an area, then we actually go looking for that specific talent. Rather than the reverse. And the same actually holds true for our general research, how we further develop the model. Same approach. We're looking at the model. We're trying to identify, obviously strengths, but most of the focus is quite obviously on weaknesses.
Sure.
So once we have identified weaknesses and areas for further improvement, that's when we try and define how do we fix that. And that goes into research rather than scouting the market for sort of general sources of alpha.
Right. Final question on this, Anders, and that is, how do you compensate and retain talented people? Because I'm not sure, I mean, the world has changed, and I'm not sure that it's just about financial reward anymore. What, in order to make people stay with a firm long term. And we know in our business that if you have someone good, and especially in research and so on and so forth, that are a little bit sensitive, ideally you want to keep people for the long run. How do you see that?
I fully agree with what you say. I perhaps outside the financial centers of London and New York, but increasingly even there, I think people are motivated by job satisfaction, having interesting jobs, being recognized for what they do properly, rather than what you get in your paycheck alone. Obviously, the paycheck is going to remain important in this business, and obviously there's going to be competitors trying to poach our employees much as
sure,
anyone else's. But we reward people here based on what they contribute to long-term business development. And importantly, at this firm, we don't have remuneration systems focusing on individual returns,
right,
like portfolio managers at prop desks or whatever.
Sure.
Really, everyone gets compensated based on company EBIT, and then we distribute that based on contribution to long-term development, idea sharing, things like that internally. Sure. Obviously, it does help from a retainment perspective that we're based in Stockholm.
Sure.
Relatively few competitors would actually target Stockholm as a market to go looking for talent they can poach.
Sure. Interesting. Thank you so much for sharing that. That's really interesting insight. Now, I want to jump to the next subject, which I tend to call track record. And what I mean by that is that looking at your track record as a whole and knowing that the market environment has changed over time, is there any particular way that one should look at your track record, certain stages, certain points in time where you may have done some upgrades? How do you look at it when you look back on your track record right now?
I think a very important point is that what we do, as we invest money, client money, based on fundamental input and thorough economic analysis of that input, is that our program is going to be relatively long-term in nature. Holding period is going to be significant, and it's really not meaningful to discuss 3-month performance, 6-month performance. Even annual might be misleading. So really you should look at our track record probably in the form of a 3-year moving average or something like that.
Right.
That's point number one. Point number two is that you're referring to changing environment. And yes, obviously, as we all know, the macro environment has changed quite a bit over the past 10, 15 years.
Sure.
Not least over the past 6 years with central bank interventions and ongoing interventions, etc., etc. But what we do is really playing markets in a very relative sense against each other. So we're trading, U.S. equities against German equities. We're trading Canadian govies against Japanese govies. And everything that a model does is done in a very relative sense. We don't really care about the absolute levels for the most part. That's sort of 90% of the story, which means that in terms of regimes and changing environment, we're probably less sensitive than someone that models each instrument in its own right, and based on each instrument's sort of absolute path. So really the way to evaluate this program is to recognize that you should be looking at 3-year moving average. Bigger dislocations in various markets may go against us for some time. Typically they do come back, and most, they almost always do. To my mind, they have always done so, but it may take a little bit of time. So this, longer term strategy and really relative. So I'm not saying that we are 100% immune against changes in regimes,
sure.
But I'm trying to say that, looking at a valuation factor on currencies, relative inflation between two countries, in the end, relative inflation is always going to have a role in the pricing of that currency pair,
sure.
Irrespective of everything else that goes on. Over time, that will play a role. It may not play a role for 3 months, 6 months, even 18, 24 months, but eventually it's going to play out. So if you trust your fundamentals and you have the patience to sit it out, knowing that you will bear, some degree of drawdown risk, then, it's a good thing to do.
You mentioned, of course, that the last 6 years has been different, abnormal, maybe even in terms of the role that central banks are playing. And if I understand you correctly, you're saying that actually over time these things will play out and it'll go back to normal. What extremes, if I can use that word, do you think we're seeing right now in this environment, and that you think will be sort of the ones when they do go back to normal that we're going to feel the most?
It is difficult to rank these extremes. Generally, my personal view, and this is obviously way outside of our investment model's view,
sure.
But my personal view would be that we're in a very stretched territory, both when it comes to quite obviously fixed income valuation and levels, but that's really controlled by central banks. But I also think if you look at equity markets generally, that are being driven and have been driven for a very, very long time by cheap money.
Yeah.
And you can extend this and look at credit and high yield or what have you. I think a large the bigger portion of asset markets, they're actually in stretched territory. They are heavily dependent on the continuation of cheap money.
Sure.
So when that changes, and indeed it's going to change at some point, we're probably in for a rough ride. Having said that, obviously the central banks also know that if they suddenly reverse this, they would have a whole community of depressed pension funds and other people to take care of. So.
Sure.
I don't think they're going to make any drastic moves.
No. And in terms of the strategy over the years, before we dive into the strategy itself, would you say, what would you say is the sort of been the main upgrades or the evolution of the strategy, I guess, over the years? And I wonder also in that particular point about, I understand the point about research and finding new ways of maybe improving existing models, but is there actually something that you would say model decay? I mean, where to a point where you would say a model doesn't work anymore? And of course, I can assume that there's certain things that could completely change fundamentally that would make it, redundant. But other than that, I mean, where you just say, this model might not work. So it's not just about the new research I'm interested in. It's actually also about whether there's been anything you had to take out along the way.
Mm-hmm. I think, generally speaking, this is, again, a long-term evolutionary process rather than sort of big changes short-term. Typically, we would introduce, 2, maybe 3 changes to the model on an annual basis. Those could be additions of new, we refer to them as risk factors or sub-models in a more general lingo. Mm-hmm. They could be new risk analytics methods being introduced into the system. They could indeed be entire new models or asset classes. We just started trading last year emerging market currencies. We haven't done that previously.
Okay.
Historically, though, I would say probably one of the bigger changes was when 4 years ago, almost to the day, we relaxed the traditional tactical asset allocation restriction, namely that for whatever, for every dollar you're long something, you're going to be a similar amount short.
Okay.
Which is, really comes from the classic GTA world where, if you overweight something, you're going to underweight something else.
Right.
We still retain this in all of our relative models where we trade equity markets against each other, bond markets against each other, and certainly currency markets. But the old time, the what was previously referred to as the global asset class decision, where you went long, $100 worth of global equities, based on some composite, then you had to go short $100 worth of bonds. That one we relaxed 4 years ago. So today we can actually be in that dimension. We can be long both global stocks and bonds, or short both.
Sure. Why did you relax it? What prompted you to actually make that change? That's a big philosophical change, perhaps.
Yeah, it's a big one, but it's also a very natural one because, again, as we moved away from the classic GTAA type setting, and most clients did by saying this is another alpha source, this is a global macro systematic.
Right.
Then there's no particular reason to have it.
Sure.
For starters. Another reason is that from a pure trading and risk perspective, it's not a very balanced way of doing decisions, because what was targeted at the GTA level was really dollars. So, buying $100 worth of equities and shorting $100 worth of bonds, obviously that's not going to make you risk neutral in any sense of the word. so from that perspective, it is not really meaningful restriction.
Yeah.
Additionally, if you look at asset class correlation structure, it has changed quite a bit over the past 15, 20 years. So as that was built into the model, hard-coded into the model, it was probably, even with the way we've designed the model today, prior to 95, 96, 97, we would probably have found ourselves in a situation where we were long stocks and short bonds most of the time, or vice versa,
right,
to the correlation structure. Whereas over the past few years, we have been long both or short both more often than not.
Yeah. Absolutely. Now, I wanted to jump to the actual strategy and talk a little bit about that. A couple of sort of questions initially is a little bit about how you would describe the objective of the strategy, and also a little bit about, each strategy has a certain environment that it performs well in, or it's been designed to perform well in, and vice versa. And I think maybe investors to some degree may not recognize this. They kind of buy things because they think they're just going to continue to make money, but they don't necessarily appreciate that there are certain times where the environment is simply not favorable for a particular strategy. But it doesn't mean the strategy is wrong. It just means that you have to accept that there's nothing that makes money every single day. So how would you describe the strategy, the objective, and the environment it's been designed to work well in?
This is a strategy that we can run at pretty much any risk level, and we can always discuss what we mean by risk here. But let's say we can run this at any level of expected volatility in the program.
Right.
And most investors, and as we cater only to institutions, they would start, and we would start feeling uncomfortable north of sort of 20-25% expected. And your typical institution, really what they need to get out of something like this is 10% net or thereabouts. Right. So what we've done is that we've said, let's find a sweet spot for the strategy at sort of 10% net per annum to client. We need to run this at a particular risk level, measured as ex-ante volatility, to make sure that we deliver in the end. And indeed, that's pretty much where we are over the course of the published track record, which is based on one of our investment funds. Sure. We're 9.7, 9.8.
Sure.
With a strategy like this, though, this is not accomplished by running a Sharpe of 1.5 or 2.
Sure.
We don't think this is realistic for this particular type strategy. Given that we're always in the market in all of the instruments that we trade on a large number of themes, there is a significant risk of drawdowns on any different dimension. Anything north of 1 over the longer period doesn't really sound very plausible. So reasonable target for a strategy like this, and this goes, by the way, I guess for most systematic managers, would be just south of 1 in terms of Sharpe. What type of environment is it designed to trade best in? Well, ideally, obviously, it should trade well in any type of environment. Sure. But generally, as we build model based on fundamental input, we are concerned with GDP levels, we're concerned with inflation, we're concerned with changes in money supply rates, etc., etc. We're relying on markets that, over a reasonable time period, responds rationally to these fundamental variables. And that's a fancy way of saying we want the markets, even if they start deviating or they go against a particular underlying fundamental development, that they will mean revert at some point in time. And we don't want that point to be 5 years out. We want that point to be 1 year, 1.5 years out. And that means that if we find ourselves in a market environment where people simply don't care at all about fundamentals, let's say they care more and only about what the Fed does, then in such periods this model could not be expected to perform optimally. It could still deliver, sure. But then it becomes more of a random game. The type of positions we may enter such period in holding may be the right ones, and they may also be the wrong ones. Sure. There's really no way of telling. So in that period, and that shifts from period A to period B, the model can be a little bit vulnerable. Yeah.
So if I try to summarize a little bit of that, is that what you're trying to do from an objective point of view is to take risk in relation to the opportunities you see.
Yes, very much so.
Okay.
Very much so.
And also, we know we've been in a world where a lot of countries, and certainly developed countries, have tried to coordinate. That, at least that's how I see it. They're trying to sort of to coordinate their economies. There's more and more integration, and if I look at different cycles of countries, they, at least for a certain period of time, where they were starting to come together much more coordinated. But now, of course, as we know, and I completely agree with you, the world seems very stretched. And there seems to be a lot of tension building up in trying to make everything the same, in lack of a better word. Your strategy, in a sense, may find it more difficult to find opportunities as they're trying to coordinate. But now, where the maybe dispersions are building up and maybe more opportunities actually for this particular strategy are emerging.
Yeah, I mean, it's an obvious sort of observation. I mean, if we started out in the early 2000s or even in the 90s, if we had started out in the 90s, it would have been, a large number of opportunities trading, Dutch equities or against German equities, or German equities against French equities. Today, that's not really meaningful.
Right.
We still trade many European markets, but it would be rare for the model to find or to recommend a position that where we would explicitly go, long Germany against a short position in France, simply because of the integration. This is driven not only by authorities, central banks, etc., but it's also driven by a very natural development. I mean, the world does get, is getting much more integrated. And certainly in Europe, countries and economies are getting a whole lot more integrated. And companies are getting a whole lot more global. Today, a very relevant question is to say, if you're trading the Dutch equity index, what are you actually trading? Are you trading the Dutch economy, or is it a global energy play?
Right.
So that's sort of one level of observations. But yes, from a model perspective, as it gets more integrated and or as authorities, central banks tries to control the markets, we're going to have to look elsewhere for opportunity, which is one of the reasons we started trading emerging market currencies. And there are other things, in the research pipeline. Other equity markets and potentially other asset classes that we're going to start trading over the coming few years, pending, successful research process. So as the world gets a more integrated place, yes, you're going to have to start looking at other instruments, other asset classes, other segments of asset classes to pick up on what you need to pick up on. That said, as we have been now in a long period where central banks have been very aggressive, whether we call that 6 years or 3 years, 4 years, doesn't really matter. We've been in a long period, and people have started getting used to this.
Yeah.
So on a relative basis, given that this is a global phenomenon, so on a relative basis, markets actually do trade around. And it's meaningful to trade markets against each other on a relative basis, although the opportunities per se may be a little bit smaller, and volatility is certainly a lot more compressed.
I think we'll probably touch upon this when we come to risk management, because obviously maybe the fact that, as you say, opportunities become smaller, we've seen certain players compensating by leveraging up, and maybe that's come back to haunt them. I want to touch upon that a little bit later. I want to dive into the strategy, and I want to ask you what global macro really means to you and how you've taken that concept and building your model. What kind of themes are you focusing on, and how you really structured taking so much information that you can obviously get when you're talking about the globe as your playing field, but structuring that into a systematic trading program.
One way of looking at this is to say that any global macro trader, and let's forget about systematic or discretionary for the time being, any global macro trader would be interested in, based on sound analysis, sound principles, identify price discrepancies based on either something that's supposed to mean revert over time, but is now moving south, and you're taking position based on it's going to be moving north at some point. Or you're taking position based on you're shorting a risk premium that seems to be excessively compressed at the current time, or you're going long, an opportunity where so you're trying to use sound analysis to identify these situations, and what really differentiates us from a discretionary trader would be to say that we have identified a large number of such opportunities, and they're coded in the form of risk factors. And we're always in the market for all of those, but at a varying degree. So as you said earlier, we're actually going to take position more or less directly proportional to identified opportunity. Whereas your discretionary manager, he would probably, distill this and try and find 1, 2, 3, maybe 4, I don't know, of the strongest teams, and then bet everything there.
Right.
And then he captures his profits, and then moves to the next area. Whereas our model is for each of the markets we trade, for each of the themes we trade, pretty much in the market at all times.
Right.
So and this is at the heart of the model. We believe in mean reversion.
Okay.
For certain phenomena, we believe in trading, obviously risk premium. You can go long and short depending on where you find yourselves, etc. So the model is built on the one axis you have 5 dimensions, and those would be the sub-models that we trade. So again, we trade relative models on emerging market currencies, developed currencies, equities, and fixed income. And then we have this previously known as asset class, but directional components. So that's 5 dimensions on one axis.
Right.
On the other axis, you would find, the types of phenomena that we're trying to pick up on. And this is common for all of the 5 submodels. We're trying to identify value,
right?
Valuation drivers. So, for example, you could probably think that something like purchasing power parity is a sound valuation methodology for currencies. So that would clearly go in the value box.
Right.
And similar type factors for other asset classes. The next dimension would be risk premium. Well, obviously, equity risk premium, long term, or bonds, or in currencies, you'd probably be talking. You may say that carry is a risk premium, and indeed, I think it is.
Sure.
So things like that will go into risk premiums. We're trading both of those. Thirdly, we find macroeconomic factors. As M2 money supply expands or contracts, as government debt issuance expands or contracts, as trade balances shift between countries, you could take position on that. And finally, we have a 4th box that we refer to as market dynamics, which is really our way of saying, here's the box where we put stuff that is really idiosyncratic to each of the asset classes we trade. So we would look at the government bond curve, the yield curve or term structure, if you like. That would be something that we focus on in our efforts in bond markets. It doesn't really apply the same way when you trade currencies. We're trying to forecast things like investment flows, cross-border investment flows for currencies, which is probably much less relevant for our equity trading. So, 5 sub-models sharing the common 4 themes, that all of them are equipped with factors identifying value, risk premia, macro developments, and then the 4th box, market dynamics.
Sure. So you have this structure. So in practice, and I hope you can explain it much more elegant than I can, but I'm trying to visualize it for our listeners, just to, how do you do these things? So is it something along the lines where you would say, okay, let's look at inflation, and we say, okay, inflation is now going up in the US, so that's gonna give, if that happens, we have a model that looks at this and it gives a certain score into a bigger pot, and then you have other things that gives other models that look at different things, and they all give a little bit of a score, if I can use that word, and that then determines overall what your position should be in that particular currency, in stock market, or how do you put all these themes together?
It's not a bad way to phrase it, actually.
Okay.
But let me try and rephrase and paraphrase that a little bit. So the first thing to know is that when we model, everything in relation to global composites. And this is really to get rid of the need to model absolute developments.
Right.
So when we're looking at government bonds or government bond futures, to be precise, we're actually looking at how the prices and the factors driving those bonds behave in relation to global basket of such government bond futures. Same for equity index futures, same for currencies. We're not looking, and this is probably enlightening, we're not looking at the traded currency pairs.
Right.
So most people will be looking at, the dollar-yen rate or euro-dollar or whatever. But we're actually looking at the yen in isolation against a global basket of currencies. So we're forming, if you like, synthetic instruments when we model.
Mm-hmm.
Additionally, everything is modeled in relation to its own history and risk adjusted. The fancier way of saying it would be, we're looking at, normalized and risk adjusted, and really what comes out of this is Z scores, number of standard deviations away from equilibrium or long-term equilibrium. So when we're looking at, for example, something as simple as 10-year government bond rates as an indication for value in bond markets. We're taking, for example, the JGB rate, and we're comparing that to this global composite, but we're not taking it outright. We're taking its risk-adjusted deviation from where JGBs normally trade. And that's what we're comparing. So it wouldn't be meaningful to take the JGBs and compare them to T-notes, because they would always be expensive, right?
Sure. So, sorry to interrupt on that point, because I think that's an interesting example, because what is the norm in JGBs anymore? I mean, 5-10 years ago, we thought, maybe that was 3%. I don't know. I'm just picking a number here. But of course, now it's been locked at almost nothing for so many years. When do you change the norm? Meaning, over how long a period do you actually need to look in order to say this must be the norm, and we're now away from that?
For most markets and for most models, we're actually using as much information as we can.
Okay.
The longest information reliable that we have, and the basis, the reason for doing that is really that markets will change and we will face different scenarios, but it is very, very difficult for us to say that, hey, the past 5 years are going to be representative for the coming 5 years or the past 10 years. Bank of Japan just started their program a couple of years ago, a year and a half ago, and that changed the equation. Who is to say that they're not going to stop next year? Yeah. So if we say that the norm today should be the past couple of years, JGB rates, and then apply that looking forward, and then all of a sudden the Bank of Japan stops doing what they're currently doing, or they run into problems and cannot do it, and JGBs just explode, we're going to be caught entirely off guard. That's So trying to be unbiased by using as much information as we can. Obviously, if we were to find a situation, one extreme would be if a central bank actually starts pegging a currency.
Right.
Then, the world has changed to the fact that we can't trade that instrument anymore, because that instrument clearly will not respond to fundamental information.
Is it important for you to understand why a market might move back to fair value, or could you simply accept it as being everything moves in cycles and therefore at some point we're going to go back to the mean?
It is important. I think generally understanding is hugely important. We think it's important that our clients understand what we do and how we do it. But in our modeling, we want to be able to understand, what are the forces that would push prices away from or back to fair value? What are the forces that would cause a particular risk premium to become over or underpriced and then subsequently to return to some longer term equilibrium? Right. So it is important, and indeed we're trying to model those forces. So if you look at our model today, there's going to be factors that are stronger in one direction than the other.
Mm. So in a sense, even though it's systematic, it's not a matter of just quantitatively assessing that there is a relationship that is stretched. It's actually also fundamentally understanding it, why it's stretched.
Yes, very much so. Okay. Very much so.
How many markets do you trade today, Anders?
Currently about 40 markets.
Okay. And am I right in saying that you don't actually trade anything over the counter?
Well,
more or less.
Currencies would be over the counter,
right?
For the most part, but otherwise, exchange traded government bond futures, exchange traded equity index futures, and then currency forwards.
Right, and it's all financial, so no commodities at this stage.
That's correct.
Right.
Which is not to say that we're not going to start trading commodities at some point in the future, but at the current time we don't.
Right. Okay. Are there any of the types of strategies you use within each theme that you can try and visualize for us? I know you've talked a little bit about it. For example, I'd love to talk a little bit about carry. Mm-hmm. I'm no expert, but obviously carry has been quite a big source of return for many people for a while. And actually my guest last week was quite concerned about some of these trades that are being put on, in his opinion, by large asset managers to compensate maybe for not making so much money in the directional arena. Because if we look at currencies, at least developed currencies, volatility has gone down dramatically in recent time, and so. Maybe talk a little bit about, how you see, if you're going to drill down on sort of your carry models, how do they work? What do they look for in your world?
Well, I think as a starting point, and this is, I don't know who said that first, but carry trading is really about picking pennies in front of a steamroller.
Exactly, yeah.
And the greedier you get, the closer to that steamroller you're going to be.
Sure.
And typically...
Thanks for listening to Top Traders Unplugged. If you feel you learned something of value from today's episode, the best way to stay updated is to go on over to iTunes and subscribe to the show so that you'll be sure to get all the new episodes as they're released. We have some amazing guests lined up for you, and to ensure our show continues to grow, please leave us an honest rating and review in iTunes. It only takes a minute, and it's the best way to show us you love the podcast. We'll see you next time on Top Traders Unplugged.